Market volatility, as you said, has indeed been very subdued the last few years, largely because we've had ultra-loose and very predictable policy, particularly from the Federal Reserve. That's obviously changing now. We've had one hike. We'll get another one or two in the next 6 to 12 months or so. So we're also seeing divergent policy among the major central banks. So we believe we've seen a structural trough in volatility. We've already seen currency volatility pick up quite sharply. We think that bond and equity volatility is likely to follow. We're also in a very low nominal growth world. That means low nominal returns. If we look at the returns that markets have produced the last 3 years, if you strip out US equities, you strip out a very volatile Shanghai market, if you look in dollar terms, you really struggle to get anything that's produced more than a few % per annum. So it's been a very tough environment. And then when we look at our 5-year expected returns, which is really the foundation of our process, those numbers, those expected returns have been trending down the last few years. So lower returns, higher volatility means other things equal lower risk-adjusted returns going forward. So it is going to be difficult. Income will remain a very important component of total return. But again, we expect rates to stay relatively low, and generally speaking, fixed income returns to remain quite paltry. So we need to adapt to this environment. We need to take a very different approach going forward. It's difficult to adopt a sort of strategic buy and hold approach. We need to be much more multi-asset in the way we approach things. We need to much more tactical and dynamic in the way that we manage money. We have to have a very diversified portfolio, both in terms of geography and asset classes, to both capture opportunities and manage risk through the cycle. So that requires a very broad opportunity set, both in terms of funds and ETFs. Not all our competitors use ETFs, but we use them quite actively. We also have to think about risk, really focus on risk and think differently about risk to how we have done in the past. Risk is very much a dynamic measure that varies through the cycle. We need to think much more in terms of absolute rather than relative risk, so in terms of volatility, a potential downside rather than tracking error. And then finally, I think one other concern we have is that we've been very used the last 15 years or so to certain correlations between major asset classes. And I think one of the challenges going forward could be that those correlations either lessen or change going forward. And some of the traditional ways of diversifying our portfolios may not be available to us.